Hello and welcome to this special telecast on ET Now as we put the spotlight to Budget 2018. Tonight on the show, we are going to focus on the tax proposals that could make all the difference, that could make or break this budget. And like with every budget, there is this one dreaded four-letter word, LTCG, that seems to have gotten a lot of market participants very anxious. We'll talk about that and a lot more when it comes to expectations on the taxation front in this special telecast. Joining us on the show is a stellar panel: Nilesh Shah, MD of Kotak AMC, Dinesh Kanabar, CEO Dhruva Tax Advisors, Bobby Parekh, founder Bobby Parekh Associates, and V. Anantha Nageshwaran, independent consultant, Van Site Consulting. Thank you all so much, gentlemen, for joining us on ET Now. Dinesh Kanabar, firstly, to set the context right, obviously one is not going to expect too much on the indirect tax front with GST kicking in. On the direct tax front as well, I want to understand how much flexibility do you believe the finance minister has to make changes, given the fact that he's constituted a panel headed by Mr. Arvind Modi to overhaul the entire DTC structure. So in that context, how much flexibility does the finance minister really have to make changes in Budget 2018?
I think even before we go to the panel which has been set up to review the direct taxes code and sort of completely rewrite it, we need to see what is the flexibility available from a fiscal side, because we are looking at current year probably exceeding the budgeted deficit of 3.2% of the GDP to somewhere like maybe 3.4% of the GDP, and all eyes will be on how is the finance minister really looking at fiscal prudence, and therefore where is he looking at his revenues from. And while, so to say, for example, on GST front, he has no flexibility really to announce the rates, because that is the domain of the GST Council. The one big question on GST is how will the collections improve? How do we see them improving? Personally, I am hugely optimistic, very bullish on how GST collections are going to stack up. And if the numbers which came in yesterday is anything to go by, my bullishness is very much warranted. But that will send the context in which what the finance minister will do or not do on the direct taxes side. And if I could break up what he can do or cannot do into two parts, one is really changes to the law, which I don't think will be very many, given, as you rightly mentioned, the setting up of an expert panel whose comments will be awaited. And second is on the rate side. You mentioned about long-term capital gains. There is this expectation as to whether the rate of taxation itself will go down from 33% to 25%, etc. So those will be the sort of things which people will be looking at, as opposed to really any fundamental change in the basis of taxation.
Fair point. Bobby, do you agree with Dinesh there that obviously he's unlikely to make any changes to the law, but he will likely tinker with rates, and there's no reason why he should stop himself from doing that, even though he has constituted a panel to overhaul the entire direct tax structure?
So, the question is whether he will or he will not, and whether he should or he should not, because whether he will or not is something which only he will know. But whether he should, I just feel like, I mean, particularly if we are talking, since we touched upon capital gains and specifically that is something which is highly topical. My own view is that I would let things lie rather than to make changes to this. I think there is a virtue in predictability and stability which we seem to forsake for what seem to be very small sort of accruals or accretions that result in the budget. And while you could argue that every sort of crore or hundreds of crores that come in is relevant from a budget balancing and a budget mathematics perspective, but I think we don't value consistency and predictability and certainty as much as they should, and it doesn't reflect in numbers directly, but it is a virtue which is underrated.
So you're saying value, predictability and consistency, don't make knee-jerk changes to the taxation structure. That's the call from Bobby Parekh. But let's dive in straight to the most contentious issue, this budget. And I would say every budget, ahead of every budget, this issue gets thrown up, it gets flagged up, it's debated, and we've seen governments fail to act on it one way or the other. Anantha Nageshwaran, a few weeks back, you wrote in a column, a democratically elected government in a predominantly poor country has no reason to exempt returns to capital from tax, making a strong case for introduction of long-term capital gains tax. Why do you say so?
Yeah, absolutely. I think first of all, if you look at the fact that the capital gains from the stock market are exempt after merely holding the asset for 12 months, anybody who has studied what a long term and short term is would understand that 12 months is really not anyone's definition of what a long term investment is. And second, why should stock market gains be treated any differently than gains from the debt market or real estate, etc.? So there is a case for revising the duration from 12 months and to be able to qualify for long-term capital gains treatment, and secondly to determine what that long-term capital gains tax treatment should be. The argument that retained earnings is already taxed, it is after all after tax corporate profits are retained, and that is what is reflected in asset prices. Everybody knows that the relationship between earnings and stock prices are completely independent, and if anything, therefore there should be a case for at least taxing the difference between the book value of equity and the market value. So either in terms of logic of long term and short term, or in terms of the logic of capital and labor, there is really no case for persisting with this exemption to stock market gains. So I think I stand by what I wrote a few weeks ago in that article that you cited.
Right. Nilesh, I comment on that. Why should stock market gains be treated any differently from debt and real estate, says Ananta Nageshwaran? And a larger question, should tax laws be an instrument to encourage investment behavior? How would you respond to that, Nilesh?
So I'm in complete agreement with Anant Nageshwaran, but there are certain local contexts in which it should be looked at. One, long-term capital gain tax is exempt because investors are paying STT on the purchase and sales of transactions. So if you want to levy LTCG, please remove STT. LTCG was removed in lieu of levy of STT, not otherwise. So it will be unfair to say that LTCG is tax-free because investors are already paying STT. Number two, there are certain loopholes which needs to be removed before we come and tinker with LTCG. For example, a listed debenture, when it goes into zero coupon territory for 13 months, the entire interest income by virtue of capital gain becomes tax exempt if you sell before maturity. Now this is interest income and it needs to be taxed. It should not be allowed to don a grab of long-term capital gain and get exemption. The second thing is bonus stripping, and I'll explain bonus stripping for the benefit of everyone, because this is something of a low-hanging fruit which is lying unutilized for last 2 decades. Suppose you have one share which is costing 100 rupee and the market price of that share is 200 rupee. Now you get 1:1 bonus on it. So you have 2 shares whose cost remains 100, and obviously the market value doesn't change with the bonus shares. So market value remains 100 because market value remains 200 because now the share price has moved to 100 rupee. In no other part of the world, bonus shares are treated at zero value. It's only in India where bonus shares are treated at 0 rupee and the original share is treated as the original cost. Now this creates a dichotomy for people who don't want to pay capital gains tax, especially short-term capital gains tax. They will buy bonus shares just before the announcement of bonus, which is come bonus price. Immediately after the bonus, they will go and sell one quantity of original bonus shares on which they will book short-term capital loss that will be offset against their short-term capital gains. And after 1 year, when they sell their bonus shares, even though the cost is 0, by virtue of long-term capital gain, it is exempted.
Okay.
If we can bring our capital gains tax at par with Western standards, then this whole bonus strippings will go away.
Okay.
Bonus stripping alone costs government between 15 to 30,000 crore.
Okay.
So you plug the loopholes of bonus stripping, you plug the loopholes of zero coupon debentures, then there is no need to tax LTCG. And if you want to tax LTCG, then please remove STT.
Okay, so you're saying if you want to tax LTCG, please remove STT and plug the loopholes. You may not even need an LTCG. But, you know, Anand, before I take it to the tax experts, Anand Nageshwar, a quick point that I want, you make it out to seem as if the gains of market investments are predominantly enjoyed by the rich and the sort of super rich. In India, there are only 3.2 crore demat account holders. How do you ensure that a move like this does not dissuade household savings? You know, over the last year, we've seen an enormous inflow of household savings into the equity market. We've seen financialization of savings, which is something that we've talked about for years. It's finally happened largely as a fallout of demonetization. That could sort of scare sort of household investors away from entering the market. A move like this, how to ensure that it doesn't do that?
Look, I mean, that's an empirical question, and you need to basically show that investors are coming into the stock market purely for the tax benefits. For that, they have a lot of other instruments. They are obviously concerned about earning a return that is better than what they would get on a typical bank deposit, etc. So if the economy is growing and if the long-term wealth is being created in the stock market, I don't think paying a tax after holding something for 3 years of 10 or 15% is going to dissuade them from coming into the market. So I don't think this argument has empirical basis even from other countries. And the point remains that it is fairly high net worth individuals, not how high we can define it, are the ones who are invested in the stock market. In fact, even in developed countries, bulk of the middle class still holds its savings in bank deposits. So it is a fact that those who access the stock market are really a cut above the rest, and for them therefore to be exempt from paying tax on these gains. We can address all the important issues that Nilesh has raised, but the fundamental conceptual case for this remains very, very compelling.
Dinesh, can I comment on that? Which side of the debate are you on? Is there a case for introduction of long-term capital gains tax? And like Nilesh pointed out, even if so, should it be only at the cost of the short-term of STT? Should STT be offset with LTCG? How do you view this issue?
So there was a point which Bobby made earlier, with which I would totally concur, that there is a great need for stability. So there were 2 points which were made earlier, A with regard to taxation and B with regard to the period of holding. Now one can keep on arguing as to whether 1 year is short term, long term, and I don't think 1 year is long term at all. But that said, we have had so many changes. We had change in 2012, we had change in 2014, we had change in 2016 on what should be the holding period. And when you keep on varying those periods year in, year out, you really need to have a table before you to compute depending on the year in which you purchase as to whether gains qualify as long term or short term. And that's not a way to make tax laws simple at all, number one. Number two, the way it is being made out is that people are making money on the stock exchange and they're not paying long-term capital gains. But as Nilesh pointed out earlier, the government took a conscious call to say that there is a STT, a securities transaction tax, which is levied on every transaction. Today what is happening is the government collections this year from securities transaction tax are likely to be somewhere between 8 and 9,000 crores. Because the market has gone up, there is sort of this feeling that there are huge amount of long-term capital gains and therefore let's tax it. That sort of one cannot predict the behavior of a market. A conscious call was made by the government that we will tax the transactions as opposed to the gains. And there was a variety of reasons. Nilesh alluded very nicely to say there are people who buy losses, all of that, and rather than get into that, there was a question of a fair tax just being imposed at a transaction level. So can there be an academic argument, a philosophical debate to say that long-term capital gain should be there? Absolutely. Question is that what is the need of that's number one. And the other point I would just like to make is that the government is as much a market participant as anybody else. We are looking at divestment, a program of the government. We are looking at huge amount of disinvestment which the government is looking at. There is a concept coming in of a sovereign fund where all the government securities could be put and sort of leverage. Now, if that's the path government wants to go down to, it cannot be that it is going to tinker around and sort of dabble with the sentiments in the market. So I'm not trying to make out at all a case to say that long-term capital gain should not be there. What I'm saying is, consistent with what Bobby said, there is a need for a consistency. You cannot just go and say that because market is going up, I'm going to charge long-term capital gains.
Before I go to Nilesh, Veeranathan Nagesh, one quick point. What are the incremental revenues? Because estimates vary from 45,000 crores to 30,000 crores. What are the incremental revenues that could potentially accrue to the government for us to really debate whether it's worth it or not?
I don't have a model, I don't have an estimate, but we are not talking about one single year. And as I mentioned, I wrote this article 4 months ago before this market made these kinds of highs. So it was not dependent on the market action. And we can always make the case against doing this in a practical sense wherever the market is. If it is down, we can say, why should you hurt the sentiment? If it is up, we can say, why should you damage the market that is currently doing well by introducing this? So there is never a good time to introduce taxes. And people don't like surprises only when it hurts them. It is not that they're against surprises. They would rather have a surprise that favors them. But if it is a surprise that is going to be considered adversarial to them, then they would say why we should surprise the market, we should keep stability. So I think the estimate should not be looked at from the point of view of 2018, 19 numbers. It's a long-term thing, and we can fix all the distortions. But it's a case that a government in a developing country need not necessarily have to favor stock market investors for 1 year. It's not about numbers. There is no philosophical case for it.
Okay. You're saying it's not just about numbers. Nilesh, now, the point that Anand made earlier in the show as well, which is that, you can't make it seem almost as if this kind of inflow that we're seeing is largely because of the taxation structure. But it's important, again, I'm trying to see if there is a case. How do we ascertain whether there is a case or not? Do you believe that the level of transactions in the market will remain the same? The sort of inflows that we see will remain the same, that they will be unaffected with the introduction of these taxes? I mean, are we to assume that behavior of market participants will not respond to the introduction of this tax? What is your view?
So, Sandeep, there are a couple of points which we should remember. While 55% of corporate India is owned by the promoters, at least for a variety of reasons, including demonetization, including market rally, including tax benefits given, today we have 1.82 crore Indians doing SIPs, and the average value of SIP is roughly about 3,000 rupees a month. Now, someone who is investing 36,000 rupees a year is not necessarily high net worth individual investors. He could be my driver and my maid also. Number two, today, the retail ownership of Indian equity is 1/2 of FII ownership. There are very few countries in the world whose largest bank, largest mortgage company, largest auto company and largest consumer company is owned by foreigner. There are no other countries which are so open. We were naive, which allowed our prize assets to go into the hands of foreigner at an early stage of development. We must look at trying to retain economic ownership of India with Indians, and if LTCG is one tool to do it, so be it. The third context which we need to see is divestment program of government. Except this year, in no year, no government has ever achieved the divestment target. It didn't matter whether markets were in full-scale Teji like 2007 or full-scale Mandi like 2008. It was only in FY 2018 that government exceeded its divestment target. And purists can say that selling HPCL to ONGC is not divestment, but keeping that debate aside, government can look to raise 1 lakh crore through divestment, and there not tinkering with LTCG will be a more better approach. So my suggestion is that let's go for stability, as Bobby and Dinesh Bhai mentioned. Let's not tinker with LTCG because you are charging STT, and in order to raise revenue, which is necessary, please plug the loopholes of zero coupon debentures, interest going away with LTCG, bonus stripping. This combination gives you resources, this combination gives you divestment program to go through, this combination gives investor stability. Net you create a practical solution which works well for you, and sometimes in future we can always go back to Anant Nageshwaran's suggestion where LTCG can be taxed.
What about moving the holding period from 1 to 2 years? Because like Anand rightly pointed out, calling 1 year long term is probably it doesn't really make sense. Nilesh, does it make sense to move it to 2 years or 3 years maybe to make it appear as long term? Because that in a sense will encourage people to stay in the market, which is what you want to do, retail investors to stay invested and not be a sort of short term investor. Is that something that the market would welcome?
Again, philosophically, yes, I would
Dinesh,
agree with
Dinesh,
you. Last year,
Dinesh,
there was a very similar case.
Dinesh, just sorry to interrupt. I asked that question to Nilesh. I'm coming to you for your response right after that. Nilesh, please go for it.
Sure. So we have seen the experience of debt market where debt mutual funds were moved from 1 year to 3 year from a lock-in point of view. It didn't have any impact on the businesses. The same will be the reaction of the stock market. Maybe there will be a knee-jerk reaction in the beginning, but that will be transient. Enhancing the holding period from 1 year to 2 year to be at par with unlisted shares or 3 years to be at par with other capital assets will be welcomed by the market.
You don't think it's such a big deal if it's enhanced from 1 year to 3 years. Okay, let's sort of settle the debate on long-term capital gains tax. We have a little more ground to cover in this debate. So Dinesh, I'm coming to you on a different question, which is on corporate tax, because that's an important aspect to touch upon as well. 3 years back, the finance minister committed to a glide path for bringing down rates to 25%. We've seen very little movement on that. We're talking at a time when Donald Trump has walked the talk on bringing down tax rates from what, over 30%. He's cut it to to the mid-20s. So he's sort of walked to 21%, if I'm not wrong. He's walked the talk on corporate tax reduction. Do you believe there's a strong case for the government to now cut the corporate tax rate in one stroke to 25%?
So, just to first go back to the fact that yes, the finance minister made a statement on the floor of the parliament where he gave a game plan which has already been implemented, whereby for almost all the exemptions and deductions, we now have a sunset clause. So bulk of the deductions are gone. There are very few deductions now remaining on the statute. And the idea was really to simplify the law, remove exemptions, deductions, and have a lower rate of tax. The lower rate of tax has been implemented for two types of entities. One is manufacturing entities and second is startups. But bulk of the corporate India continues to be under the old regime. You make an important point with regard to USA. USA has indeed come back to say that will reduce the rate of tax from 35 to 21. In fact, I was just looking at some of the news which have come over the last 2 days. At Davos, for example, we had Jamie Dixon of JP Morgan come back and say how he believes USA and his own bank, which is one of the largest banks in the world, has become competitive thanks to the reduction in the rate of tax. We have seen how Apple, for example, has come back to say that they're going to get about $250 odd billion back into USA and pay an incremental tax of $38 billion. I read a similar statement yesterday from the CEO of Barclays on how he believes this is a very welcome move. So USA believes that it has got a huge amount of upside as a result of the reduction in rate of tax. We need to know two things. First is USA as a market is a hugely tax compliant market and the base of taxpayers is very large. The US MNCs have traditionally stacked money overseas and therefore as a result of reduction in the rate of tax, there is that expectation, and not just expectation, one is seeing really a movement of funds from outside of USA into the USA. India has a slightly different scenario. Our economy largely is insular. Is there a case to make us competitive and reduce the rate of tax? Absolutely. But that needs to be balanced with fiscal prudence. So if the finance minister goes, USA for example is looking at $1.3 trillion of additional deficit as a result of the reduction in the rate of tax, and they believe, and the jury is still out on this, as to whether the growth in the economy will more than make up for this $1.3 trillion of reduction of taxes. India is not in that zone. So much as I would very much like the finance minister to reduce the rate of tax, and I think there's a strong case out there, I think if he balances it with fiscal prudence, I think he might find it difficult to match it. And I would therefore really budget something like a midway going down from 33 to 25, somewhere midway, where the finance minister I think needs to walk the talk, whereby he's going on to his commitment, he's making things less taxable, but at the same time he's sort of balancing it with fiscal prudence.
Important point. Anand Nageshwaran, come in on the buoyancy of a rate reduction, because obviously we're struggling to kickstart the investment cycle. Private investments is nowhere close to turning, and there are people who believe that investment in the economy is directly proportional to the tax rate. So you bring down tax rates drastically, it will lead to more investment. Do you buy that theory? And does that and given what we've seen happen in America, does that sort of build a case for the government to cut corporate tax rates sharply?
I would think so. I agree with Bobby that it was a promise made on the floor of the parliament and in a budget speech, and it has not been honored, and that's not a good sign. And also, removing exemptions is important part of this package, not so much for revenue considerations, but what happens is when you give so many ad hoc exemptions, you end up demanding more and more of those who pay. So your tax base narrows, and you end up actually trying to raise more money from that narrow tax base. Whereas if you remove lots of ad hoc exemptions and keep the rates reasonable, you bring more people into the tax net. And I think at this stage, India must be willing to take a bet on growth given its development cycle and expect that a lower tax rate, higher economic growth would bring in more revenues than a smaller tax base, ad hoc exemptions, and an oppressive and a coercive tax regime. That is the mix we have. I think we should move towards a mix where there is a wider tax base, very few exemptions, reasonable rates, and an attitude of trust and verify rather than mistrust and over verify and over coerce. So I think that is the model that needs to change. So all these things have to happen as part of the package. Then I would bet on tax buoyancy, making up for higher tax rates.
I can't imagine anyone disagreeing with what you just said. But Nilesh, given the political climate, we are looking at elections a year down the line. Given the political climate, do you see the government moving swiftly on cutting corporate tax rates? Is that likely to be on top of the finance minister's mind when he's got a rural constituency to please, when he's got the middle class to take care of? And we will talk about what to expect from a personal income tax as well in just a bit. Given this sort of political climate, do you expect this to be on top of his priority list, a cut in corporate tax rates?
So my guess is that our government is asset rich and liquidity poor. In order to provide funding for agriculture, rural and infrastructure ahead of election year, the government need not only tinker with taxes, it can always monetize its assets. I mean, one simple example is in 2002 we divested BSNL. There is 700 acre of land lying over there. If you monetize that, that can give you anywhere between 10,000 crore to 15,000 crore. We created custodian of enemy property in the 60s. 1,25,000 crore AUM is lying over there. You monetize that, you will have 25,000 crore for next 5 years or more. So finance minister can be innovative in monetizing assets and raise revenue, cut the corporate tax rates and incentivize corporates to create jobs, employment or make investments for further growth, and yet achieve the fiscal deficit. The need of the hour is being innovative rather than stereotype.
The need of the hour is to be innovative and look at other asset monetization avenues. That's something that one can't sort of disagree on that front at all. Okay, quick closing comments. Dinesh, coming to you. Then what else do you expect the finance minister to do in this budget? I mean, there are things that, and that you think probability of them happening, anything on the DDT, for example, or any other proposals. Do you think he should do more on the personal tax front, leave more money in the hands of the middle class? What else do you expect from the finance minister in this budget? Dinesh.
So in fact, I would really go back and say that the finance minister should do as minimal as possible, because this is not a time to make changes. There are things which are going right, one should allow them to go right. I am of course seeing a slight increase in the threshold limit for taxation going up from 2.5 lakhs to maybe 3 lakhs. I would like to believe that a marginal reduction in the rate of taxes is going to leave more money both in the hands of the consumers, and therefore sort of increase the consumer spending, which would be very welcome. There has been this whole debate on with regard to dividend distribution tax. I don't think this is the time to look at it at all. If at all, as you rightly pointed out, that would come in the context of what the Direct Taxes Reforms Committee comes up with. So I would say less is more in a context like this. Make as minimal changes as possible.
Less is more is Dinesh's advice to the finance minister. Don't sort of crack your brains too much. Keep it simple. Bobby, do you agree with that? Keep it simple. Keep it predictability. That's what people want. In any case, we are going to be in for a bit of a overhaul once the direct tax reforms kick in.
I would agree with that, Sandeep. I think that For a variety of reasons. I mean, one is the point which I've been making, and I won't repeat that, but even otherwise, more importantly, as Dinesh was also commenting, if the law is going to get overhauled in any case, then why fiddle with it? So do whatever is the barest minimum that is required. If there are some things which are not clear, you want to do it. If there's some loopholes that need to be plugged, then you plug those, but otherwise just let it be where it is. Pick it up when the law change needs to happen. I mean, there's many things which need to be done, but then let it get all addressed comprehensively when a revised or a refreshed law is being considered.
Sure. Anand Nageshwaran, one point which you sort of briefly touched upon, but do you expect the government to move on that front, which is widen the tax base? You know, successive governments have completely failed in widening the tax base. I mean, demonetization may have led to some sort of a widening, but not enough, at least not as much as people sort of expect. And we heard the finance minister allude to it as well in the previous budget speech when he pointed out the extent of poor compliance, tax compliance in this country. Do you expect something concrete on that front in this budget, a concrete effort to widen the tax base?
I think I don't expect concrete measures because their attitude towards widening the tax base has been to sort of let loose a more of a repressive regime of searches and seizures and unilateral notices and retrospective tax claims, etc. That is not what I had in mind. When you talk of widening the tax base, you really sort of make people feel that this is a reasonable tax regime with which I have to comply. And it is not just a question of rates, it's also a question of tax administration. And the World Bank looks at overall tax liability in India, not just the income tax, and it is still 55% for a mid-sized corporation of 50 crores turnover. So it is a fairly high tax regime. They need to take a look at that one, and they need to believe that if we incentivize growth, tax revenues will come through. So I don't expect him to make concrete measures because the accent is somehow on the morality aspects of tax collection rather than seeing it as a tool to benefit from facilitating economic activity and benefiting from that. I think this has become too much of a morality play, and I don't think that's the right way to look at public policy or fiscal policy.
Nilesh, comment on that, because we speak to people in Delhi, and I can tell you, people, and you would agree, you would have probably got that sense as well. People in the corridors of power are frankly exasperated at the poor tax compliance in this country, that they almost feel as if tax evasion is a culture, it's a way of life, and that they need to do something by way of public policy to change that. Is that the right approach? Is the first question. Number two, what can they do sort of strategically in this budget to broaden the tax base? Or do you think they should just wait it out? The combination of demonetization and GST, which will also potentially bring in a lot more people in the direct tax net, will reap the benefits and will in itself widen the tax base over a period of time. What would your advice be in terms of approach to widening the tax base, Nilesh?
So one, there has to be fear of law. Unfortunately, in India, what we see is very, very low fear of law. The mighty doesn't fear of law because the judicial process is long and they can get away by retaining best of the brains in the country. The public doesn't fear the rule of the law because they know that they are a vote bank and no government will take action against them if they are a public. The same culture is reflected into tax compliance. It is a matter of great shame that our tax to GDP ratio is lower than African nations like Rwanda. Being a chartered accountant, little familiar with how people pay tax, it's a common parlance to hear things like entry, gift, AOP and trust structures to save taxes. There are all kinds of ways and means in which people avoid paying tax. Even today, non-GST bill has become parlance in local language. So how can government improve tax collection when people are not afraid of rule of law? Is there a way to improve it? I think we must admit that we can't change public mindset in a very quick time. If 5 people break the law, that's breakage of the law. But if 50% of population is breaking the law, you need to amend the law. On one side, we can use technology, and the government has collected lots of data under demonetization deposits. The second as Dinesh Bhai and Bobby were mentioning, you need to give some amount of consistency of taxation rules so that people can comply with it. Third, we have to plug the loopholes, and I can talk about one more loophole being estate duty. In most parts of the world, estate duty is an accepted form of taxation. In India, it's not there. So we need to plug the loopholes like bonus stripping, zero coupon debentures, estate duty, and so on and so forth. And fourth, we need to create public pressure through efficient enforcement of law, that people start respecting the law. Right. We won't be able to improve tax compliance in a short period of time, but if we Lagero Munna Bhai type, then I'm sure it can change.
Indeed, it can change. Okay. Closing comments, just 30 seconds to the two tax experts. One, I'm going to put you in a spot, Dinesh Kanabar. One out-of-the-box idea for the finance minister to raise revenue. You're all experts at telling what he should not do, but one out-of-the-box idea from you and Bobby. Nilesh spoke about estate duty, but one out-of-the-box idea to raise revenue, because let's face it, the government has a serious revenue pressure as well. Dinesh, you go first.
So, one very simple thing really is we have got securities transaction tax, the rate of which can definitely go up.
Okay, so you're saying you take the rate of securities transaction tax up. Bobby, your turn for an out-of-the-box idea which the finance minister can use to raise revenue in this budget.
Reduce the tax rates and make tax compliance easier.
I knew that was coming. I thought it'll come from both of you, but it's come from you for sure. We'll leave it at that, gentlemen. Really appreciate you taking the time and joining us on this discussion on ET, now putting the spotlight on on the taxation proposal, specifically the long-term capital gains tax, and whether or not there is a case for it, and the impact of such a move if it were to come through. I guess we'll have to wait till the 1st of February to find out what the finance minister exactly has in his mind. Thanks for being with us on the India Development Debate right here on ET Now.